small finance bank has underperformed in the past 4 months, whether you compare it with the flattish performance of a Nifty 50 or a 4% degrowth on Bank Nifty. Asset quality concerns because of the pandemic and a few senior management exits. Now, those two things did not go down too well with the street. However, if you look at the Q2 FY22 show, it was resilient both from a growth as well as asset quality standpoints. With the third wave of COVID-19 knocking at our door, sentiment could remain subdued. Although the impact of a third wave could be short and intense, we do not expect a widespread economic disruption this time around. Financials, the likes of AU, could continue to underperform if we look at the near-term picture. However, the resilience of the business model will help the company come out stronger. So this period essentially could turn out to be a golden opportunity for long-term investors. The bank's deposit base has seen a steady growth with increasing share of retail deposits. The share of deposits in total borrowing stood at 86% in the last reported quarter, as against 68% in the year-ago period. The share of low-cost CASA has improved to 31% from 21% in September 2020 quarter. Almost the entire asset book is now funded by deposits, which is a key driver of interest margin, despite the bank lending predominantly to secured assets. At the start of its small finance bank journey back in 2017, the cost of funds was close to 9%, which has now come down to 6.1% with incremental cost of funds at 5.3%. Post the outbreak of the pandemic, the bank's collection efficiency dipped with a sizable proportion of the book in moratorium. However, as restrictions were lifted gradually and business activity resumed in a staggered manner, the bank's business also picked up and collection efficiency soared to 109% at the end of September 2021. Reported gross and net NPAs that stood at 4.3% and 2.3% at the end of June 21 declined sequentially to 3.2% and 1.7% in Q2 of FY22 on the back of improved recovery. The bank had a standard restructured portfolio of 1,300 odd crores at the end of the first half of FY22, which accounted for 3.6% of gross advances. Majority of these loans were restructured in Q4 FY21 and Q1 FY22. The bank has a provision cover of 49% against its gross NPA and 16% against restructured loan, and also carries a buffer provision to the tune of 300 crores and is comfortable with the cover should the third phase doesn't turn out to be too disruptive. We have nevertheless factored in higher provisions for FY22 and expect normalization by the second half of FY23. Management feels that most borrowers are engaged in livelihood activities, and unless the COVID situation worsens significantly, resumption of economic activities would reduce the stress. The second wave of the pandemic was a speed breaker in the bank's growth journey. However, disbursements surged 50% YOY and 171% sequentially in the last reported quarter with the resumption of economic activities. The asset book remains dominated by secured retail assets, whether it's autos, lending to SMEs, and relatively new but fast-growing book of home loans. In the relatively smaller wholesale book, the bank continues to reduce its exposure, whether it's to NBFCs or to real estate sector. The secured asset book gives us comfort that the downside to asset quality is limited should COVID cause disruption. The bank has a very comfortable capital position with a capital adequacy ratio of 22%. Once normalcy returns, AU should have a strong trajectory of growth backed by competitive liability and technological edge. It will be an advantage position to take market share from weaker banks and NBFCs who will be rendered very weak post the COVID crisis. While the valuation looks optically expensive, it is worth keeping in mind that at the time of AU's IPO in 2017, the IPO was valued at 4.5x 1-year forward book and got listed at 6.6x 1-year forward book. So we're getting a high quality franchise at a discount to its IPO valuation, and therefore long-term investors should gradually look at accumulating the stock.